September 15th, 2008, 4 a.m., Manhattan. A century-old bank ceased to exist before sunrise. Lehman Brothers filed for Chapter 11 bankruptcy with $613 billion in debt. To calibrate that number, if you spent $1 million every single day from the birth of Christ until today, you still wouldn't reach $600 billion. This wasn't a company going out of business. It was the structural collapse of the fourth largest investment bank in the United States. And it happened while most of the world was asleep. As the sun came up over New York, cameras captured thousands of Lehman employees walking out of the headquarters carrying cardboard boxes. The public saw the desk lamps and the framed family photos and thought, tough luck for the bankers. The bankers weren't the ones in real trouble. You were. Here's why. Every night, banks lend each other billions of dollars to balance their books. It's as routine and invisible as breathing. The plumbing of modern civilization. But when Lehman Brothers vanished, that routine trust evaporated instantly. Every bank on the planet looked at its neighbors and asked the same question. If they died overnight, who else is infected? Are you safe? Am I? The interbank market froze solid. Banks stopped lending, not just to risky players, to everyone. Within hours, the contagion jumped from Wall Street computer screens to the streets of the real world. Small business owners in Ohio trying to get routine inventory loans were told no. Car dealerships in London were told no. General Electric, the backbone of American industry, suddenly couldn't find the cash to cover its Friday payroll. Inside the U.S. Treasury, the mood was apocalyptic. Secretary Hank Paulson and Federal Reserve Chair Ben Bernanke weren't looking at a stock market crash. They were looking at what economists call a sudden stop. A scenario where, by the end of the week, ATMs would stop giving out cash. Where grocery stores couldn't process credit cards. Where the modern world simply ceased to function. So how did a few million houses in the American suburbs manage to bring the most powerful economy in human history to its knees? Why was the system so fragile that one bank's failure could threaten to send the world back to the 1930s? To find the answer, we have to go back to the pink stucco houses of the mid-2000s. That's where the fire was first lit, 2003 to 2006, the American suburbs. For half a century, the American dream ran on a simple contract. Work hard, save your money, and one day you'll own a piece of the earth. The home was the safest investment a person could make, because, as the saying went, house prices always go up. By 2003, that contract had been quietly rewritten. Wall Street had discovered that the American mortgage market, worth trillions of dollars, underpinned by real assets and historically stable, was the ideal raw material for a new generation of financial products. The demand from investors was nearly unlimited. The supply of creditworthy borrowers was not. So the definition of creditworthy began to change. Traditionally, a mortgage required a 20% down payment, a verified income, and a demonstrated ability to repay. These were prime loans, safe, predictable, and increasingly scarce as the market matured. To feed the machine, lenders moved into the subprime market. Borrowers with poor credit histories, unstable incomes, or no meaningful savings. In any previous era, these borrowers would have been declined. In the mid-2000s, they were actively recruited. The reason was structural. Banks were no longer holding the mortgages they issued. They were selling them almost immediately to Wall Street. which packaged and resold them to investors around the world. The moment a loan was sold, the originating bank's exposure ended, which meant the bank's incentive to verify whether the borrower could actually repay also ended. The result was the ninja loan: no income, no job, no assets. In Florida, Nevada, and California, mortgage brokers were closing deals on behalf of borrowers who had no realistic path to repayment. Strawberry pickers earning $14,000 a year were being approved for $500,000 homes. Applications were routinely falsified, salaries inflated, assets invented, because the broker's commission was paid at closing, not at month 36 when the payments stopped. The mechanism that made this seem temporarily viable was the adjustable rate mortgage. These loans offered artificially low teaser interest rates for the first 2 or 3 years, rates low enough to make the monthly payments appear manageable. After the teaser period, the rate would reset to market level, often doubling or tripling the payment. Borrowers were told not to worry. House prices were rising fast enough that they could simply refinance before the reset hit, locking in the appreciated value at a lower rate. That logic held, as long as prices kept rising. By 2006, the total value of outstanding residential mortgages in the U.S. had reached $10 trillion. Entire planned communities were being built in the Nevada desert and sold before the concrete had dried. From the outside, it looked like prosperity. Underneath, it was a market entirely dependent on the continuation of conditions that couldn't last. The mortgages were the foundation. What Wall Street built on top of them is what turned a housing correction into a global emergency. Wall Street. Early 2000s. Wall Street had a problem. It had an enormous growing pile of risky mortgages and a planet full of investors hungry for yield. The solution was a financial engineering process called securitization, and it would become the most consequential and catastrophic innovation of the early 21st century. Here is how it worked. A single subprime mortgage is an unattractive investment. One borrower, one job, one bad month away from default. But take 10,000 of those mortgages, pool them together and sell shares in the pool. And now the logic changes. Statistically, not all 10,000 borrowers will default at the same time. The pool absorbs individual failures. This is the mortgage-backed security, or MBES. Then came the next layer, the collateralized debt obligation, or CDO. Banks took slices of multiple mortgage pools and repackaged them into a new structure, divided into tranches by risk. The bottom tranche absorbed the first losses. The top, the senior tranche, would only suffer if an extraordinary proportion of the underlying mortgages failed simultaneously. The mathematical models said that was nearly impossible. Those models went to the rating agencies, Moody's and Standard and Poor's. The agencies reviewed the formulas, accepted the logic, and stamped the senior tranches with AAA ratings. The gold standard. Theoretically as safe as U.S. government debt. The consequences were enormous. Pension funds in Norway, insurance companies in Tokyo, municipal governments in Australia. All of them bought these products, trusting the ratings, believing they were holding safe, high-yield assets. They were holding concentrated exposure to millions of American borrowers who couldn't afford their mortgages. The banks earned fees at every stage, originating the loans, building the pools, selling the tranches. The more mortgages they could feed into the machine, the more fees they collected, which is precisely why nobody stopped to ask whether the borrowers could actually pay. That question had become someone else's problem. By 2006, the answer to that question was arriving in the form of missed payments. But before the scale of the damage became visible, another layer had been built on top of it, one that would turn a serious problem into a global catastrophe. 2005 to 2007. The global financial system. Investors holding mortgage-backed securities wanted protection. What if the mortgages defaulted? Wall Street had an answer: the credit default swap, or CDS. A CDS is a contract. The buyer pays a regular premium to the seller. In exchange, if a specified set of mortgages defaults beyond a certain threshold, the seller pays out the full face value of the loss. AIG, the largest insurance company in the world, became the dominant seller of these contracts. They collected billions in premium income for what they believed was a theoretical risk. House prices, after all, had never fallen on a national scale in modern American history. There was a structural flaw that almost no one examined. A regulated insurance company is legally required to hold capital reserves, actual cash, set aside against the possibility of claims. The credit default swap market had no such requirement. AIG was accumulating obligations worth hundreds of billions of dollars with no meaningful reserve behind them. They were, in effect, writing checks against an account they hadn't opened. The market grew stranger still. You didn't need to own the underlying asset to buy protection on it. Investors with no exposure to a particular pool of mortgages could still purchase a CDS on it, essentially a pure bet on whether it would fail. This created what's called a synthetic CDO, a financial product whose value was entirely derived from credit default swap contracts with no actual mortgages underneath. The notional value of these instruments eventually reached tens of trillions of dollars, a multiple of the actual mortgage market they were supposedly tracking. The result was a web of mutual obligation connecting every major institution in the global financial system. Goldman Sachs held contracts with AIG. AIG had obligations to Deutsche Bank. Deutsche Bank was counterparty to funds in London, Tokyo, and Zurich. No single institution had a clear picture of its total exposure because the chain of contracts was too long and too complex to trace. This is what made September 2008 so dangerous. It wasn't just that Lehman Brothers had failed. It was that nobody, not the regulators, not the banks themselves, knew exactly who was holding the risk or how much of it there was. The entire system was wired together with obligations no one fully understood. In early 2007, the first payments started to stop. The teaser rates on those subprime mortgages were expiring, and the revised bills were arriving. Monthly payments were jumping from $1,200 to $2,500 overnight. Families discovered their homes were worth less than they owed. They couldn't refinance. They couldn't sell. They handed the keys back to the bank. The defaults began as a trickle. Within months, they were a flood. And the world was about to discover that the company standing behind trillions of dollars of promises had nothing in the vault. Early 2007, the first tremors, the first signs didn't come from Wall Street. They came from front lawns. In the suburbs of California, Las Vegas, and Florida, for sale signs were staying up longer, much longer. The math was simple and brutal. The teaser rates from 2005 were resetting. Families paying $1,500 a month suddenly owed $3,000. They looked to refinance and hit a wall. For the first time in decades, house prices had stopped rising. In some places, they were falling. If your house is worth $400,000, but you owe the bank $450,000, you're underwater. You can't refinance, you can't sell, and you can't afford the new payments. They handed the keys back to the bank. In February 2007, HSBC quietly announced it was increasing reserves to cover massive losses in U.S. subprime mortgages. The first major institution to admit the rot was real. Weeks later, New Century Financial, one of the largest subprime lenders in the country, went bankrupt. But while the big banks were still in denial, a small group of outsiders had been watching the data with quiet intensity. These were the shorters, investors who had looked at the actual default rates hiding inside those AAA bundles, realized the ratings were a fiction, and decided to bet against the entire structure. They were buying insurance on a collapse that every expert said was impossible. They looked insane. They were about to become extraordinarily rich. By August 2007, the contained problem had spread. The French bank BNP Paribas suspended 3 investment funds, admitting it had no way of valuing the assets inside them. That was the moment trust died. If a major European bank didn't know what its own holdings were worth, who did? Banks began charging each other higher rates to lend overnight, the financial equivalent of neighbors changing their locks and pulling the curtains. The Fed cut interest rates and pumped cash into the system. It wasn't enough. The era of easy money was over. The Great Liquidation had begun. September 13 to 15, 2008. New York. By September 2008, the chill had become a hurricane. Bear Stearns, an 85-year-old institution, had already vanished in a forced sale to J.P. Morgan Chase in March. Fannie Mae and Freddie Mac, the 2 giants guaranteeing half of all U.S. mortgages, had been seized by the government. The dominoes were falling faster than anyone could set them back up. Then came the weekend of September 13th. The heads of Wall Street's surviving banks were summoned to the Federal Reserve Building in New York. Hank Paulson and Ben Bernanke delivered an ultimatum. Find a way to save Lehman Brothers, because the government is not stepping in. Paulson wanted to kill the idea of moral hazard, the dangerous assumption that reckless institutions would always be rescued by the taxpayer. No buyer emerged. Barclays wanted Lehman, but the British regulators blocked the deal. Bank of America looked at the numbers and walked away to buy Merrill Lynch instead. At 1:45 a.m. on Monday, September 15th, Lehman Brothers filed for bankruptcy. The shockwave was immediate and global. Lehman wasn't just another bank. It was a central node in the financial nervous system, woven into contracts and obligations with institutions on every continent. When it went down, the interbank market didn't just freeze, it shattered. Then came the next blow. AIG, the insurer that had sold trillions in protection on those mortgage bundles, admitted it was out of cash. Billions owed, zero liquidity. If AIG went under, every institution holding a policy with them would go with it. Total systemic failure. The government's no bailout policy lasted exactly 24 hours. Paulson and Bernanke rushed to Congress with a 3-page document requesting $700 billion. Their message was blunt. Pass this, or there may not be a functioning economy on Monday morning. It was called TARP, the Troubled Asset Relief Program. The free market had to be placed on life support by the state. The banks were too big to fail, and the American taxpayer had just become the unwilling buyer of the world's largest pile of toxic debt. 2008 to present, the $700 billion bailout stopped the bleeding. The scars lasted a generation. While the banks were being rescued with public money, 4 million Americans lost their homes to foreclosure between 2008 and 2012. Entire neighborhoods became ghost towns. Retirement savings accumulated over decades dissolved. Unemployment climbed to 10%. The wealth effect that had fueled the mid-2000s was gone, replaced by the Great Recession, the deepest economic contraction since the 1930s. The bitterness was hard to overstate. The architects of the crisis, the traders, the analysts, the executives who designed and sold those bundles of rotting debt, mostly kept their fortunes. Almost no senior Wall Street figure went to prison. The system had been saved. The trust never fully came back. The ghosts of 2008 are still visible in almost everything. The crisis gave birth to Occupy Wall Street on the left and the Tea Party on the right, seeding the populism that would reshape politics across the Western world for the next 15 years. In January 2009, an anonymous creator named Satoshi Nakamoto launched Bitcoin, citing the bank bailouts directly as the reason a new decentralized currency was necessary. Today, the banks are larger than they were in 2008. The too big to fail problem hasn't been solved. It's been managed, monitored, and quietly hoped away. We are still walking through a world built on the architecture of that collapse, living under regulations written in response to a disaster we've already half forgotten. Here is what 2008 actually taught us, stripped of all the jargon. The global economy is a single organism. When one part fails, the infection spreads faster than any government can contain it. Complexity is not sophistication. It is often a disguise for risk that no one fully understands, not even the people who created it. And the word save, in finance as in life, is always promise made by someone who hasn't yet been tested. The question isn't whether another crisis is coming. The question is whether next time we have the courage to look at the gold and see the lead before the machine starts to turn. If you want more stories about the systems that shape the world, subscribe.